Our next guest says the word of the day is Goldilocks. Let's go to Jimmy Lee, CEO of Wealth Consulting Group. He joins us now. Thanks for your time.
Hi, good afternoon.
So Goldilocks implies, of course, that there is a balance. Everything is just right. But consumer sentiment is very weak in the U.S. So does that fit the narrative?
It actually does. We think that, consumer sentiment being bad, which it has been for a long time now, is actually positive if you're bullish on equities. And so we think that, that contributes to why there's so much cash on the sidelines, the, $7-8 trillion in money markets, plus all the other cash and treasuries and so forth. There's a lot of money sitting on the sidelines on both balance sheets of consumers and really corporate America. I think that companies have also been preparing for recession, and it's showing up now in the jobs reports, right? So I think that going forward in 2026, there's going to be more of a fear of jobs and employment than inflation. I think inflation, really, the headline number may come down as we get more of the housing data into the current numbers as that's being reported throughout the year. And I'm hopeful that the Fed ends up cutting more than what's predicted by the market, which will, help equity prices.
Okay, so what would you say is driving the markets right now?
Well, I think it's going to be about fundamentals again. So I think that what is consensus is that analysts predict, that earnings are going to grow double digits, maybe 15% year over year, which is very high. Now, I think the tough part about that is that the expectations are going to be higher this year than they were last year. But margins are also expanding, and I think that's part of the secret sauce here, is that as the biggest input cost for profits, which is labor, is kind of holding steady because jobs have been slow. That's helping companies to increase margins, which they did last year. I think that story is going to continue to play out. Now, that being said, I think we're going to see a broadening out of what's been working in the market. So I think you can get follow through on small cap stocks, which have rallied, this year past the technology and large cap stocks. I think you're also going to get follow through on international securities. So international markets, I think, are going to have another good year relative to the U.S. And so it's not going to be about the Max 7 anymore. As money comes off the sidelines, and a lot of people have missed this, bull market since the lows of 2022, including a lot of institutional investors. I think they're looking for value.
Okay, and you are favoring cyclicals right now along that same line.
We do, and so we think that cyclical sectors such as industrials, financials, materials, even consumer discretionary will participate, as we're not going to be in a recession. And if we do end up getting stimulus from more refund checks, from the big, beautiful bill, and consumers will tend to spend that money, we think that that's going to be helpful. We know that the Fed's also doing a little bit of quantitative easing, as we, who knows if they're going to get a rate cut here in January or not. I tend to believe that we're going to get more rate cuts than what's predicted. That being said, I think there's more stimulus that's being put into the economy. And so I think that's going to be helpful for risk assets. And so we think that the cyclical sectors will do well.
Okay, so you touched on what you think could drive the markets higher this year. Are there one or two catalysts you're focused on that you think could really have that effect?
Well, geopolitical has been at the top of my list for a while now, and we're but we're continuing to see it where it's head again. And as investors are thinking that we're through the tariffs, and on the other end of that, in terms of what to expect and how that's going to affect company margins, you're seeing a lot of stuff come out of the White House in terms of rhetoric around tariffs, even depending on geopolitics, right? So geopolitics still continues to be very high for me. I think that we could get some animal spirits. So if we get the residential housing market to unlock, which is one of the things that I think would change consumer sentiment, I also believe that would really boost the economy and get a lot of other areas moving in the economy that aren't moving yet. But if the residential housing market unlocks, which means that mortgage rates have to come down significantly, and a lot more action happens in the residential housing market, we could get animal spirits, which could melt the stock market even higher to much higher parts of the range that we have for 2026. If that happens, I could see potentially a correction afterwards.
Are you looking outside of the U.S. at all, more internationally?
As I said, we do like international equities. We think that foreign markets present more value. I mean, it's always been the story for a number of years now that companies are a lot less expensive overseas than they are here in the U.S. We also have earnings expectations to be very good in the emerging markets as well. And so yes, we think that geopolitics will continue to be a concern, but we think international markets will be have another good year. And I think a lot of U.S. investors are underweighted international. And so I think it's a good time for all investors to look underneath their hood and make sure that their global asset allocation is prudent.
Okay, are there certain countries you're looking at, certain regions you're looking at, certain sectors in those regions?
We do like, the Asian markets, and we also like some of the European markets too, though. But I think Asian markets are good. But overall, I think in general, overseas outside the U.S. Presents more value and has more earnings opportunity than maybe some of the more richer sectors in the United States. And so that being said, we also still like tech. I mean, tech we think is good to buy on the dips. Tech's not a sector that we would be negative on. And as we get mega cap tech earnings out this week and continuing on this quarter, we think that tech's going to continue to do well. We think that AI spend's not nearly close to being done yet. You're also going to see second and third derivatives of the AI spend come into play. And I think we're going to start to see, companies report productivity results from the AI spend. And as those results come in, it's really going to dictate, which companies that investors are going to favor.
Yeah, definitely will be watched closely as they start to report their earnings. Jimmy Lee, thanks for joining us. Appreciate your time.